Hello there. Hope you're doing well. So today I want us to talk about the mathematical truth behind risk management and surviving long-term prop firm challenges, and not only in prop firm challenges, but also your personal account as well. And These are very important series because a lot of people come into trading and the first thing they think about is how to make money. That's how they learn. They learn the technical side of it, the fundamental side of it, but they forget the most important side of it, risk management. Because risk management is what is going to determine whether you survive these markets or you blow account within the first day. Now, a lot of people, a lot of beginners often blows their accounts because they over leverage and nobody tells them that this game is a game of probability. So they think that now maybe because they've had a winning series and now that dopamine, has rushed over their minds and they just see like they feel like they're gonna be winning always. Then when a loss comes, then the psychology is messed up. Then one loss leads to another, to another, to another. At the end of the day, the account is gone. And you see, with the program psychology or program task is that they give you like a 10% that is maximum drawdown. Then they give you like also 5% daily drawdown. So, and 10% maximum drawdown simply means that if you're risking 1% per trade, you'll have 10 trades to take. If you lose the 10 trades consecutively, then boom, you're done. If you're risking 2% per trade, you only you're only five trades away from blowing that account. If you lose only five, meaning that if you have a losing week, then that account is gone. So as much as this is nothing to do with strategy, mostly this is more about psychology and how to survive in the long run in this game. This is the most important thing. So there's something important I want to talk about when it comes to trading that we often ignore, and I ignored this and I learned the hard way. This is trading will only expose your bad habits. We are human beings. You and I, we do have our bad habits that we often don't really um, don't know until something triggers them. A very good example is most of us, including me, I've always had this problem of poor money management. Whenever I have money, I spend it. I spend it, bro. I buy stuff. I buy things. I see something I like, I buy it. I don't care. Like I've been that type of guy who like balling, like just spending money randomly. And you see, this is the opposite of how wealthy people behave. You'll never see a wealthy person throwing out money just here and there. They don't do that. You'll never see a wealthy person just buying stuffs randomly, not unless they are in a wealthy situation whereby they don't, you know, wealth, wealth, and and being rich are quite two different things. Being a wealthy person is definitely something to do with generational, uh, gains, and you and your children and your children and your grandchildren, are gonna be benefiting, from whatever you possess. But now being rich is quite different. Being rich is something that you can consume just in your generation, like then it's done. Okay, so you will find that majority of wealthy people, when they get their money, they don't run for Lamborghinis, they don't run for Bugattis and so on. They invest. The first question they ask themselves is that, okay, I have a business running. How much is my business, returning, per month or annually? And does this allow me to afford luxury? But you see, a trader will make, like, let's say $1 million, or maybe half $1 million, or maybe a couple of $100,000. Then the first thing they do, they go and buy cars. They buy cars and cars and cars and cars and so on. Then when things go south, because you see, cars are liability. They have to be serviced, they have to be fueled. Like, it doesn't add value in your real life, not unless you've reached a stage whereby you don't really care about spending a couple of hundred thousands per month on just your maintaining your properties and so on, unless you've reached that level. But as a trader who wants to generate wealth and also create generational wealth that can last long for a generation, you have to behave like somebody who is doing business. You have to treat this thing as business. It has to be like business. When you open your business right now, for example, let's say you just open a restaurant. You don't open a restaurant, then just, giving away all the profits. Doesn't that won't manage, that business will not stand like that. You have to respect risk. You have to respect that this business is growing. I need to be ready. For example, in the long term or in the long run, for example, if an emergency happens, let's assume a fire broke out. If you did not, sorry. So as I was saying, you have to treat this as a business. Nobody opens a business, then they start, misusing their capital. Okay. So, assuming you just started your business today, and in this business, you have back tested and you've analyzed that your probability of a winning trade consistently is around, let's say 50%. 50% with a 1 to 2 risk to reward ratio, 50% with a 1 to 2 risk to reward ratio is very, very, very profitable. Because you see, if you lose, if you lose, for example, the first trade, or let's say out of 10 trades, you lose five, you win five. Okay. Remember, you're only losing 1%, but you're gaining 2% in every single trade. It is a good risk to reward ratio. Okay. So meaning that at the end of the day, if you lose five, meaning that and you win five, definitely you're still gonna be up around 2.5%. If you lose five, okay, you have 10 trades. You have 10 trades, okay? Sorry, you're gonna be up. Is it 5% for sure? Uh, let's do the math. You have 10 trades, and out of these 10 trades, you've lost five, meaning that 5% is gone. But you've won how much? You've won five, okay? So if you're winning five, remember that every single trade you're taking is giving you 1 to 2, 1 to 2, 1 to 2. So when you take that 2 times 5, you get 10. Minus the 5 that you have lost, you're going to be up 5%. You see how even having 1 to 2 R is profitable. Now, if you have a higher risk reward than this, it's even way better. So as by right now, even before we talk about this, you're supposed to know that what is your strike rate? Does your strategy have a one to do one, no, like a 50% strike rate? Do you win 50% of your trades or less than that? And what is your risk to reward ratio? Because if, for example, you're let's say you're losing uh, the 5 out of 10 and you have a risk to reward of 1 to 1, that's not profitable. That's not profitable. It's just a break even, like not really even break even. It's almost, because meaning that you're going to be losing five trades and winning five trades. So what have you done there? It's nothing. It's just still in the same place. So 1 to 1 R, as much as it always has a very high win rate, but you need to have a risk reward that is above 1 to 2. Okay. Now once you have this, there's always one rule that most traders usually ignore. You can't just take any random trade, because out of these trades, we do not allow room for making mistakes. We only take trades that align with the setup, nothing less, nothing more. Because if you end up taking a target or taking up a trade that doesn't align with the with your high probability setup, then definitely you're gonna lose it. Now that being said, most people when they begin trading, they are never told about this thing about risk management. And even me, I was never, nobody told me about this thing. I learned the hard way. Make sure you have planned risk beforehand. How much are you willing to lose that day? And if it is met, walk away. These things have relationship with how you as a person behaves. If you're a person who is always impulsive on spending, if you always buy stuff, unplanned, and so on, or you just do things unplanned, definitely that will also manifest in trading. You'll end up taking unplanned trades. If you're a person who is weak in terms of when you see other traders winning and making money, you also want to do what they're doing, and you just want to compete, that will have an effect on you. This is why it takes people 4 to 5 years to even, like, more than 2 years to even see a payout or even having money on it, because these are the reasons. The world that we live in has not prepared us for this type of environment. We have not been taught anything to do with financial discipline, even in schools. We haven't been, like, all they teach us is work hard, 9 to 5, be a servant. Like, that's what they teach us. But now that's the opposite of what happens here. What happens is very simple, and it is hard because we are not used to it. We struggle with this because our brains have not, we're not used to it. Okay, so we need to have a risk management parameters whereby if you're risking 1% per trade, that trade has to be A plus setup. It has to be a valid setup, because remember, we only have 10 trades, only 10 trades. These 10 trades, if you take random trades within a week or even a couple of, like, if let's assume per day you're taking two trades, 1% per trade, right? If you lose 2% one day, it's done. And having a red week is easy. It happens. You can just have a red week, because right now, like, for example, things that are happening. You see around the world, we have the US and Iran war going on, and you see even gold, the way it is behaving right here. It's kind of a tricky situation, the way gold is behaving. Not unless you are deeply, you are very very you understand deeper concept of price and so on. Because right now I'm pretty much sure there's a lot of sellers that are already trapped in this game. But there's something going on here. Gold had an unfinished business up here, and you see it tricked us. We drop down into what? Into this order block. After tapping this order block, you see it is now pushing high again. And the moment today we close above this swing high, and tomorrow, for example, the day after tomorrow, we end up creating a gap here, definitely, my guy or my friends, we are going up here to finish that business. And you see, all these have consequences with what's happening with the geopolitical factors. For example, right now, US is waiting for Iran to sign or for Iran to agree to the terms of ceasefire. Now, when Iran and US have a ceasefire, automatically gold is a safe haven. It's gonna push higher. But the moment these people start bombing each other, and fighting, definitely it's gonna be dropping. So if these people align and they agree to do business and so on, because most people will say, okay, we wanna pay in gold, we wanna do investment in gold. They don't wanna work with the dollar. Then definitely gold is gonna push higher. If they start fighting, then US start, having demands, like everything must be done on our currency and so on. Like, it gives dollar like a very tricky situation. So that's what's happening here. So once you have a good strategy, ensure that you only risk what you're willing to lose. I find 1% per trade is a very sweet spot, and taking one trade per day is even way better. So meaning that per week you can even have only three trades. Three trades, if you have a good risk to reward ratio, for example, 1 to 3, you are way ahead of a lot of people. If you take a look at that monthly, you are way ahead of a lot of people. Instead of having 5 trades per day, but you ended up, taking a low probability trades, because having taking many trades, trust me, requires a lot of experience and requires a lot of discipline. Because at some point you're going to lose. The more trades you take, the more the more the high chances you're going to lose, and the higher the chances that you're going to react, emotionally from them. And you see, reacting emotionally from this kind of situation is now what makes people fail in this game. This game doesn't want emotions. You just have to do what you have to do and walk away and let the markets, just play their part. So that being said, I'm gonna be doing a market review in the next few. So first thing, if you want to change your risk management, or your bad habits in trading, first change the change the habits you have in your daily life. If you're that person who like buying stuff randomly, overspending money, not respecting money, not respecting risk, you're impulsive, you just misbehave and so on, then definitely trading is not for you. Not unless you fix those things first, because those things are gonna manifest in trading, and when they manifest in trading, it's you losing money. This is the truth that most people don't tell you. So you have to look at your life like, are you a disciplined person in real life? Like, do you respect risk? Do you respect your finances? Do you have a plan? Do you plan for your finances? Do you treat this as business? When you treat this as business, what I simply mean is that you don't take random trades. Like, you just don't sell things at a less value than what you bought them from. Because taking a low probability trade is literally you trying to sell whatever stocks you bought at a loss. So you're not, in short, you're desperate. But instead, you could say, you know what, I'm waiting for my potential client, I'm waiting for my potential customer. That is your A plus setup. And when that customer arrives, it is business on. But when you become, emotional, afraid of missing out, afraid of losing, afraid, fear and so on, then at the end of the day, you end up taking these low probability setups, which taking random clients who are not going to give you profits, and that's how you blow your accounts. So these things has a personal relationship to your personal life. So that's something you need to really work on. And the mathematical truth behind is that this whole math, if you've been given 10% maximum allocation, 5% maximum drawdown, you're only far away. This is easy to lose, especially this 5% if you're reckless. It's easy. I've done it a couple of times. It's easy. And you even never know how it happens. You only realize that boom, you lost the money. Because when you're in that revenge mode, you lost a trade, and it's all about over trading. So when you just trade one session, one asset. This idea of people trading gold, trading this pair, that pair, I don't usually find it a good idea. It takes a lot of experience to be able to trade different assets. But even if you're trading different assets, maybe two, maximum three, this idea of a beginner wanting to trade five pairs, trust me, you're missing a lot. I used to be like that. I used to trade Nasdaq, gold, German 40, US 30, and Euro USD. Nowadays, I focus mostly on gold and a little bit maybe on Nasdaq sometimes and maybe German 30, just a little bit, but mostly I'm on gold. Mostly, a few people have been watching my channel for the longest. It's always about gold. So these are some of the things that can help you, in surviving the long term, because you can just master one asset, like where it's coming from, why it's dropping here, why it's coming up here. But if you're trading a lot of assets, you won't even have those details. It's just random, and that's why most people lose. And also learning from the wrong teachers. People don't even know what they're saying, or what they're doing. So you end up losing, and you think, it's okay, it was just a loss, a bad. No, it's not just another loss. You made a mistake somewhere because somebody who taught you did not even know what they're doing. You must have answers. For example, I've told you guys, why is this market coming from this area? We tapped an order block here. Order blocks is a change of state of a delivery. Apart from that, we took some swing low right here, and the price closed back in. And what are we doing right now? As a result, we're pushing higher. So what's our target? Was this PDRA that I just marked here, this bearish gap? If we end up closing or disrespecting it, then definitely these are drawn liquidity, showing that price is interested in coming up here. Once we attack this PDRA, we might want to tap something here, this order blocks. Okay, then we drop now. So that's it. But uh, see you guys in the next one about the market review on gold and so on.